I've spent 70 years studying money, and I can tell you with absolute certainty that most people have it completely wrong. They think money is currency. They think it's numbers in a bank account. They think it's what you use to buy things. But after 7 decades of observation, analysis, and real-world experience building billions of dollars in wealth alongside Warren Buffett at Berkshire Hathaway, I've learned something that changes everything. Money is not what you think it is. And once you understand what it actually is, your entire relationship with wealth will transform. Let me be blunt. The reason most people stay poor is not because they don't work hard enough. It's not because they don't earn enough. It's because they fundamentally misunderstand the nature of money itself. They're playing a game without understanding the rules. They're using a tool without understanding how it works. And as a result, they spend their entire lives working for money when they should be making money work for them. I'm 99 years old as I share this with you. I've seen economic cycles come and go. I've witnessed the transformation of American capitalism. I've studied every major financial system in history. I've analyzed thousands of businesses and observed countless individuals build and lose fortunes. And through all of this, one truth has become crystallized in my mind with absolute clarity. Money is not a thing. Money is a concept. And the way you think about that concept determines everything about your financial life. Most people think of money as an end goal. They say, I want to make money. I need more money. If I just had more money, everything would be better. But this is backwards thinking. Money is not the destination. Money is a tool. It's a measuring stick. It's a claim on future productivity. And most importantly, it's a test of your character and your wisdom. Here's what I've learned. Money amplifies who you already are. If you're generous, money makes you more generous. If you're greedy, money makes you more greedy. If you're wise, money gives you more opportunities to apply wisdom. If you're foolish, money gives you more ways to be foolish. Money doesn't change people. It reveals them. And this is the first great misunderstanding that keeps people trapped in poverty. When I was young, growing up during the Great Depression, I watched people's relationship with money very carefully. I saw families who had money lose everything. I saw families who had nothing build something substantial. And the difference was never the amount of money they started with. The difference was always their understanding of what money actually represented. Let me share a fundamental truth that took me years to fully grasp. Money is stored time and energy. When you work, you're converting your time and energy into money. But here's the critical insight that most people miss. Not all time and energy is created equal. An hour of a doctor's time is worth more than an hour of a dishwasher's time. Why? Because of the knowledge, skill, and value creation capacity that's been built up in that doctor through years of education and training. This is why simply working harder is not the path to wealth. You cannot work your way to richness by trading more hours for money at the same rate. The mathematics doesn't work. There are only 24 hours in a day. You need sleep. You need rest. You can only work so many hours. So if you're trading time for money at a fixed rate, your income has a ceiling. And that ceiling is much lower than most people realize. The wealthy understand something different. They understand that money should be used to buy assets that generate more money. They understand that the goal is not to accumulate currency, but to accumulate income-generating assets. This is the distinction between working for money and having money work for you. And it's a distinction that separates the wealthy from everyone else. At Berkshire Hathaway, Warren and I have spent decades perfecting the art of capital allocation. That's a fancy term for figuring out what to do with money to make it multiply. And here's what we've learned. The value of money is not in having it. The value is in deploying it wisely. $1 sitting in a bank account earning 2% interest is worth far less than $1 invested in a quality business earning 15% returns year after year. But most people don't think this way. They think about money as something to spend or save. They don't think about money as something to deploy strategically. They don't ask, where can I put this money so it works hardest for me? Instead, they ask, what can I buy with this money? This fundamental difference in questioning reveals a fundamental difference in thinking. And that difference in thinking creates a massive difference in outcomes over time. Let me tell you about compounding, because this is where the magic of proper money understanding reveals itself. Albert Einstein supposedly called compound interest the most powerful force in the universe. Whether he actually said that or not, the principle is true. When you understand compounding, you understand that time is your greatest asset when building wealth. Here's how most people think about money growth. If I invest $10,000 and it grows by 10%, I make $1,000. Next year, I make another $1,000, and so on. But that's linear thinking. Compounding doesn't work linearly. It works exponentially. In year one, your $10,000 at 10% becomes $11,000. In year two, that $11,000 grows by 10% to become $12,100. You're now earning returns on your returns. And as this process continues over decades, the numbers become extraordinary. I've seen countless people who had the opportunity to build significant wealth but squandered it because they didn't understand this principle. They received money and immediately spent it on consumption. A nicer car, a bigger house, luxury items that depreciate in value. They converted their money into things that don't generate returns. And in doing so, they locked themselves into a life of working for money instead of having money work for them. Here's a specific example. In the early days of Berkshire Hathaway, we bought a textile mill. It was a struggling business, but we saw value in it. Over time, we realized the textile business itself wasn't going to make us wealthy, but the cash flow from that business could be redeployed into better businesses. So we took the money the textile mill generated and invested it in insurance companies, banks, and eventually exceptional businesses like See's, Candies, and Coca-Cola. What we were doing was converting one form of money into a better form. We weren't just accumulating dollars. We were accumulating ownership in excellent businesses run by excellent people. And those businesses generated profits, which we reinvested into more businesses. This flywheel of intelligent capital allocation is what turned a struggling textile mill into a company worth hundreds of billions of dollars. But you don't need to be running a major corporation to apply these principles. The same logic works at every level. If you're earning $50,000 a year and spending $50,000 a year, you're stuck. You have no capital to deploy. You have no way to make money work for you. But if you can live on $40,000 and invest $10,000 in assets that generate returns, you've started the process. And if you can maintain that discipline for decades, the compounding effect will transform your life. The problem is that most people lack the temperament for this approach. They want immediate gratification. They see their neighbors buying new cars and they want new cars. They see people taking expensive vacations and they want expensive vacations. They're playing a status game instead of a wealth building game, and the status game is designed to keep you poor. I've always lived below my means. I've never been interested in conspicuous consumption. I still live in a house I bought decades ago. I don't own a yacht. I don't collect expensive art, not because I couldn't afford these things, but because I understand that every dollar spent on consumption is a dollar that can't be deployed into assets. And over a lifetime, that difference compounds into tens of millions of dollars. This is what money actually is. It's a tool for buying time, freedom, and options, but only if you use it correctly. If you use it to buy status symbols and impress people who don't matter, you're converting a tool for freedom into a chain of bondage. You're trading your future freedom for present consumption. And that's a trade that most people make without even realizing they're making it. Let me address another massive misconception about money. People think that making more money will solve their problems. But I've observed something interesting over 70 years. People who are bad with $1,000 a month are usually bad with $10,000 a month. The amount doesn't fix the behavior. Poor money habits scale with income. This is why lottery winners often end up broke. This is why athletes making millions of dollars file for bankruptcy. Having more money doesn't make you better with money. It just reveals your true relationship with it. What matters is not how much you make, but what you do with what you make. I've known people who earn modest incomes but build substantial wealth through discipline and intelligent investing. I've known people who earned enormous incomes but died broke because they spent everything they made. The difference was never the income. It was always the behavior. Here's a framework I use to think about money. There are three uses for money: spending, saving, and investing. Most people only think about the first two. They earn money, they spend some, they save some. But saving money in a bank account earning minimal interest is not wealth building. It's wealth preservation at best, and wealth erosion when you account for inflation. Real wealth building happens through investing. And investing means putting your money into assets that generate returns higher than inflation. This could be stocks, bonds, real estate, businesses, or any number of other vehicles. The specific vehicle matters less than the principle. You're converting present money into future money generating capacity. But here's where it gets interesting. Not all investments are created equal. In fact, most investments are mediocre at best. The stock market as a whole has historically returned around 9 to 10% annually. But that's an average. Many stocks return far less. Some lose money entirely. The skill in investing is identifying the exceptional opportunities and avoiding the terrible ones. At Berkshire, Warren and I developed a philosophy of investing in wonderful companies at fair prices rather than fair companies at wonderful prices. This might sound simple, but it's profound. Most investors are always looking for bargains. They want to buy something cheap and hope it becomes expensive. But we realize that buying truly exceptional businesses, even if you pay a full price, leads to better long-term results than buying mediocre businesses cheaply. Why? Because wonderful businesses compound value over time. They have durable competitive advantages. They have excellent management. They operate in favorable economic conditions. They generate cash that can be reinvested at high rates of return. And over decades, these factors create enormous wealth for shareholders. Mediocre businesses, even if bought cheaply, tend to stay mediocre. They require constant capital infusions. They face competitive pressures that erode margins. They don't generate excess cash that can compound. So even if you buy them at a bargain price, they don't create the compounding machine that builds real wealth. This principle applies beyond just stock investing. It applies to how you think about everything related to money. Buy quality. Focus on value, not price. Think long-term, not short-term. Be patient. Let compounding work its magic. These principles sound simple, but they're incredibly difficult to apply consistently because they require you to resist powerful psychological impulses. Human psychology is wired for short-term thinking. We want immediate rewards. We struggle to delay gratification. We're influenced by what others think. We make emotional decisions and rationalize them with logic. All of these tendencies work against successful money management, and overcoming them requires conscious effort and discipline. I've studied human psychology extensively because understanding it is essential to being a successful investor. I've read widely in psychology, behavioral economics, and cognitive science. And what I've learned is that our brains are terrible at thinking about money rationally. We're prone to all sorts of biases and errors. We overweight recent information. We see patterns where none exist. We're overconfident in our predictions. We follow the herd even when the herd is wrong. Successful money management requires you to overcome these natural tendencies. You have to think probabilistically. You have to separate signal from noise. You have to maintain emotional equilibrium when markets are panicking or euphoric. You have to avoid the mistakes that everyone else is making. This is extraordinarily difficult, and it's why most people fail at building wealth, even when they have the opportunity. Let me share another critical insight about money that took me years to fully appreciate. The best time to build wealth is when you're young, but young people almost never do it because they don't understand the mathematics of compounding. If you start investing $1,000 per month at age 25 and earn 10% annual returns, by age 65, you'll have over $600,000. If you wait until age 35 to start, you'll have less than $250,000. That 10-year delay costs you more than $350,000. But most 25-year-olds don't invest. They're focused on spending. They're establishing their lifestyle. They're trying to impress others. They think they have plenty of time to start saving later. But later turns into never, or later turns into too late. And they wake up at 50 years old with no retirement savings and no path to financial independence. This is tragic because the solution is so simple. Live below your means when you're young. Invest the difference. Let compounding work for decades. Don't try to keep up with your peers' consumption. Focus on building assets, not acquiring liabilities. The discipline required is minimal compared to the results it produces. But most people can't do it because they can't resist the temptation to spend. I want to talk about something else that's crucial to understanding money. The difference between income and wealth. Most people confuse these two concepts, but they're fundamentally different. Income is the flow of money you receive. Wealth is the stock of assets you own. You can have high income and low wealth if you spend everything you earn. You can have low income and high wealth if you build up assets over time. The wealthy focus on building wealth, not just earning income. They understand that assets are what provide security and freedom. A high-income professional who spends every dollar might feel rich, but they're actually trapped. They have to keep working to maintain their lifestyle. If they stop working, the money stops. They're on a treadmill. But someone with substantial wealth in the form of assets has options. Their assets generate income without requiring their labor. They have true financial freedom. This is why I've always been more interested in acquiring ownership in great businesses than in earning a high salary. Ownership of productive assets creates wealth that compounds and endures. Salary, no matter how high, stops when you stop working. And even if you save your salary, it requires active decisions about how to invest it. But owning pieces of excellent businesses means those businesses are working for you, generating profits, reinvesting in growth, and compounding value year after year. Let me address the question of how much money is enough. I've seen people destroy themselves chasing more and more money long after they have more than they could ever spend. The answer to how much is enough depends entirely on what you want money to do for you. If you want money to buy freedom, to give you options, to allow you to work on what interests you rather than what pays the most, then enough might be far less than you think. I've lived a comfortable but not extravagant life. I have everything I need and most of what I want, but I've never needed a $100 million yacht or a private jet or multiple mansions around the world. These things don't add to my happiness. In fact, they would likely subtract from it by creating complexity and distraction. So for me, enough was reached long ago. Everything beyond that is just a way of keeping score in a game I enjoy playing. But many people never reach enough because they're constantly moving the goalposts. They think if I just had $1 million, I'd be set. Then they get 1 million and decide they need 5 million. Then they get 5 million and decide they need 20 million. The target keeps moving because they're not clear about what they actually want money to provide. They're chasing an abstract concept of more rather than a concrete goal of enough. This is a recipe for unhappiness. You can't win a game where the finish line keeps moving. You'll spend your entire life in pursuit mode, never satisfied, never content, always chasing the next milestone. And when you finally realize this, often late in life, you'll discover you've wasted decades pursuing something that was never going to satisfy you. Here's what I've learned about money and happiness. Money can solve money problems. It can eliminate financial stress. It can buy comfort, security, and options. But beyond a certain point, more money doesn't create more happiness. The research on this is clear. Once your basic needs are met and you have some buffer for security, additional money has diminishing returns on well-being. What this means practically is that the pursuit of wealth beyond what you actually need for the life you want to live is a waste of time and energy. You'd be better off using that time and energy on relationships, learning, creative pursuits, or anything else that actually enhances your life. But most people never figure this out because they're trapped in the cultural programming that says more money is always better. I want to share something about risk that's essential to understanding money properly. Most people think avoiding risk is the path to financial security, but that's wrong. The real risk is not taking enough risk. If you keep all your money in cash, you're guaranteed to lose purchasing power to inflation. If you invest only in ultra-safe, low-return vehicles, you're guaranteed to accumulate wealth slowly, if at all. The key is not avoiding risk, but taking intelligent risks where the odds are in your favor. This is what Warren and I do at Berkshire. We take risks, but we only take them when we believe the potential reward significantly outweighs the potential downside. We look for asymmetric bets where we can risk $1 to make $3 or $4 or $5. We avoid situations where we might risk $1 to make $10. The math has to work heavily in our favor before we commit capital. Most people do the opposite. They take unintelligent risks. They buy lottery tickets with negative expected value. They invest in things they don't understand because someone told them to. They follow hot tips and trends. They're essentially gambling rather than investing. And gambling, by definition, is negative expected value over time. The house always wins. And in financial markets, the house is the collective wisdom of all market participants. You're unlikely to outsmart them consistently without an edge. My edge has always been patience, discipline, and independent thinking. I don't follow crowds. I don't panic when others panic or get euphoric when others are euphoric. I think for myself. I do my own analysis. I wait for opportunities that meet my criteria. And when I find them, I bet big. This approach requires enormous patience. There are long periods where there's nothing to do. But the ability to wait for the right opportunity is what separates successful investors from everyone else. Let me talk about leverage, because this is an area where people frequently misunderstand money. Leverage means using borrowed money to amplify your investments. It can multiply your returns, but it also multiplies your risk. Many people have destroyed themselves with leverage. They borrow money to invest, the investment goes down, and they end up owing more than they have. This is catastrophic. I've generally avoided leverage in my personal investing. I've never wanted to be in a position where I could be forced to sell assets at unfavorable prices because of debt obligations. Warren and I use some leverage at Berkshire through our insurance operations, but it's very conservative and carefully managed leverage. We never put ourselves in a position where external forces could cause us problems. The average person should be extremely cautious with leverage. Borrowing to invest in the stock market is almost always a mistake. Borrowing to buy consumption items is definitely a mistake. The only leverage that makes sense for most people is a reasonable mortgage on a home you live in, and even then, it should be conservative. Don't borrow more than you can comfortably afford to repay. Don't stretch yourself thin. The stress and risk aren't worth it. Now let me address something that many people struggle with, the relationship between money and values. I've always believed that how you make money matters as much as how much you make. There are many ways to get rich, but not all of them are ethical or sustainable. I've never been interested in making money through deception, manipulation, or exploitation. I want to make money by creating genuine value, by helping businesses succeed, by being a good partner and steward of capital. This might sound naive, but I've found it's actually the most practical approach. Unethical behavior might produce short-term gains, but it destroys trust and reputation. And in the long run, your reputation is your most valuable asset. People do business with people they trust. Opportunities come to people with good reputations. If you build a reputation for integrity, fairness, and competence, you create a compounding advantage that pays dividends for life. I've also learned that you have to be comfortable saying no. The ability to say no to bad opportunities, bad deals, and bad behavior is essential to long-term success. Most people say yes too often. They take on commitments they shouldn't. They invest in things they don't understand. They go along with things that make them uncomfortable because they don't want to miss out or disappoint someone. But every yes to something is a no to something else. If you say yes to a mediocre investment, you're saying no to keeping your capital available for an exceptional one. If you say yes to spending money on consumption, you're saying no to investing that money in assets. The opportunity cost of your decisions is real, even if it's invisible. And over a lifetime, making the right choices about what to say yes and no to is what determines your outcomes. Here's my final and perhaps most important insight about money after 70 years of study. Money is ultimately a tool for living well. It's not an end in itself. The purpose of accumulating wealth is to have the freedom to live according to your values, to do work you find meaningful, to help people you care about, and to make a positive contribution to the world. If you lose sight of this and make money accumulation the goal itself, you've missed the point. I've known extremely wealthy people who were miserable. They had all the money they could ever spend, but they had no close relationships, no sense of purpose, no joy in their daily lives. And I've known people of moderate means who were deeply fulfilled and happy. The difference was never the money. It was always how they thought about life and what they valued. Money gives you options, but it doesn't make decisions for you. You still have to decide what kind of life you want to live. You still have to figure out what matters to you. You still have to build relationships, find meaning, and create something worth doing. Money can make all of this easier, but it can't do it for you. So here's what money actually is after 70 years of careful study and observation. Money is a tool for converting your labor into stored value. It's a medium of exchange that allows specialization and trade. It's a claim on future productivity. It's a test of character and judgment. It's an amplifier of who you already are. It's a scorecard for how well you understand value creation. And, most importantly, it's a means to an end, not an end in itself. If you understand these things, if you truly grasp what money is and what it isn't, your entire financial life will transform. You'll stop making the mistakes that keep most people trapped. You'll start making the decisions that compound into wealth over time. You'll use money as the tool it's meant to be, rather than being controlled by it. And you'll build not just financial success, but a life of genuine value and meaning. The question now is, what will you do with this understanding? Will you continue thinking about money the way most people do, or will you embrace a more sophisticated and accurate view? The choice is yours, and it will determine your financial future.